Rizwan, good to see you. How are you?
Good to see you, Andrew. How are you doing?
Yeah.
Great, great. Yeah, it's been good. Rizwan's on two of our properties right now, and
Yeah. Hi.
Yeah, and it's impressive how fast Andrew and Marco, you guys are moving. It's unbelievable, especially the property at I believe Bancroft.
Bancroft. Yes. Yeah.
Yeah,
Bancroft.
it's awesome to see the progress on that.
Yeah. Yeah. It's we're almost there. We're almost done.
That is very cool.
awesome, guys. Well,
I can get
today, very
started.
excited.
Yeah.
Today, I'm very, very excited. We're going to be talking about backyard apartments, and we are with Next Wave. Next Wave is it's an homage to both surfing, the Next Wave as a waiting on the surfboard, waiting for the next wave to come, and also the Next Wave in housing solutions here in San Diego.
Yeah. And of course, we always start with a disclaimer. We are managed by SEC regulations. So our lawyer, who's our Securities and Exchange lawyer, make sure we give our disclaimer, which is that we're neither lawyers ourselves nor are we investment advisors. We're not CPAs. So for any of that, please make sure to look for your own professionals that you trust. And of course, we make assumptions here, but there are no promises as to returns, and everybody invests at their own risk.
So today we're gonna go through quickly the jobs and investment portfolio, why we like backyard apartments, the opportunity at Tennyson Street, which is the property that we have now in escrow in Point Loma, and then a big thing too is we want to talk about how to mitigate risks, because of course we can talk about all the beautiful, amazing upsides and all the opportunities, but the most important thing is that we make sure that we take care of the risks. It's better to protect stuff than it is to talk. We want to protect first and then grow second, right? Exit strategies, and of course, how to sign up if you're interested.
Yeah, so a little bit about myself. We were talking a little bit before about the beaches and how we got to San Diego. Uh, I got here through the U.S. military. I was stationed at Camp Pendleton, and I did like the beaches so much I decided to stay and found ways and reasons to stay. So I actually did a part of my graduate degree here in San Diego. And through that, I managed to meet somebody at Qualcomm. So I spent quite a few years at Qualcomm. I did two expat assignments, one first in Brazil, where I met my wife, and then in the UK. And that was quite different. Came back and decided I wanted to get more into real estate. So I kind of, over time, evolved my way more and more into real estate. That way, for one thing, I didn't have to travel so much. I was doing business development, doing a great deal of travel. So that allowed me to stay here and also be much more entrepreneurial and do what I love doing now, which is building and developing real estate.
Yeah, and I'm Andrew Erickson. Marcel and I are both 50/50 partners on Next Wave, and I'm a data expert. I have a degree in applied mathematics and electrical engineering from CU Boulder. And I came here, like Marcellus, I also came here for the beaches, but Qualcomm is what attracted me here. I was able to afford the beaches at least. And I started there about 10 years ago. So brought me down here to San Diego. And I then cut out from the traditional 9 to 5 and have been an entrepreneur now for 7, 8 years now. And so I've created a couple different companies, and we've taken some of those companies and I've had 7-figure exits selling those companies. So I'm just a serial entrepreneur and just love this kind of stuff. And I also love real estate. And so I now have a portfolio of $4 or $5 million of real estate, which actually technically is a lot higher now that we have more of the Next Wave stuff, which is pretty cool. And so I'm a big I like the systems and processes and doing the data analysis, finding the good deals, and how to maximize a return on businesses like this.
Yeah, cool. And so I had originally formed the Next Wave Group after I had left Qualcomm with the idea of, again, my passion, investing in real estate. Along about 4 or 5 years ago, San Diego, well, first state of California and then San Diego, started adopting much more, I would say, just much more fully the whole process of accessory dwelling units and how to be able to be part of the solution in addressing the affordability crisis that we have throughout California, but of course here local in the state of California. So again, as Andrew said, we'd met up and have decided to really team up and move forward and really again using what we call backyard apartments and a lot of different methods, which we'll talk about in terms of being able to underwrite the properties, how we build. Rizwan had mentioned how quickly we built the first project that we have within the fund, and working to transfer that to the follow-on project so that we're able to scale this very efficiently and to be able to deliver in a timely manner, because of course time is money and more important than money even, and provide great returns to you, our investors. And so Andrew and I, towards the end of last year, we'd said, what's a good metric? What is it that's going to kind of help provide our vision for this year and that gets us into the next? So what we're looking to do is to bring on in a potential of 100 units. So you could either buy a 100 or build a 100 unit apartment building, or what we're going to do is acquire properties such that as we're doing the planning process and the construction, that we have the potential to get to 100 units that will be delivered next year, but that we will take on that potential in this year and raise $10 million in order to be able to obtain that goal.
Yeah, and this is the path to 100 units. So not 100 units built by the end of the year, but enough properties to fill. Oh, I'm gonna just mute you when I get a little bit of feedback. So I'm just gonna mute. There you go. And actually, we should update this slide because just in the last month we've already added another 6, so we should be at 30 there. And yeah, so it's going along nicely. We are mostly on track for this number. So the quick thing here, and again, some of the stuff it's we're gonna go through quickly some of the stuff just to kind of paint the whole picture, and we want to talk a little bit about the job of an investment portfolio. What we need to do with our investments. And there's really 3 jobs if you think about it with your investments, and that is to protect against inflation. So to kind of current income protect against inflation in the future. Long-term growth, so don't let it be eaten away by inflation. Hopefully it greatly exceeds inflation and has that long-term growth, and then also to reduce risk and to have diversity in your portfolio. And so we found this interesting chart here that's from Tiger 21, which is basically a mastermind for ultra wealthy people, and they did an analysis to figure out what kind of what people's portfolios look like when they get into what's considered ultra wealthy. And the big thing here is you can see a huge chunk of it is real estate. So 25% real estate. And of course, a lot of people are business owners. So they also have a huge chunk in private equities. So it's just kind of interesting to see that this is, real estate needs to be a large component of your investment portfolio. And with real estate, there's many ways to invest in real estate, but what we think is the best way to do it is to invest passively, right? And the big reason there is you don't have to worry about tenants, toilets, or trash. You don't have to worry about the literal, that.
Yeah, and in fact, a lot of the properties that we end up acquiring are from people that own them themselves, and who have not dealt very well with the tenants or the toilets or the trash. And so they tend to be in pretty poor condition because people think that real estate is a passive investment, and it is anything but. So just an important thing. I've actually once received a call that a squatter had broken into a property and actually overdosed and passed away in my property. So it can definitely be a real strain. So the other benefit, I think, is that also when investing through folks like ourselves, is that we have the expertise and the focus on actually driving the best value. And so you can kind of maybe decide to go through the school of hard knocks, but that's a hard way to do it. Whereas when working with us, you've already got people who, that's our specialty. So at any rate, enough of that. Talk a little about this. This is actually very exciting to me, this part about supply dynamics. So people talk so much about the affordability crisis and different solutions. Well, to me, the answer is very simple. It's provide more supply. And I like the mayor of the city of San Diego. He has a phrase, and it's just build with a period, and then more with a period, and then housing with a period. So San Diego's been very aggressive about that. And so it actually, that combined with low interest rates actually brought real results. Over the last 12 months, San Diego was kind of flattish because we delivered so many units to the market that rent kind of, well, first of all, it had spiked greatly, then kind of has come down and it's been relatively flat. But now what we've seen is that the housing starts are falling right off a cliff. So right now, housing starts are somewhere between 30 to 60% off of the peak, and that's because mainly of interest rates, which have skyrocketed. So in this chart, I'll kind of explain. Over on the left-hand side, you see the multifamily completions, and there have been periods where we've reached certain peaks. So even though it seems like we're at a really, a high point here, off to the right-hand side of this chart, in actuality, we'd reached that number before in the 1970s. And of course, now the population in the United States is nearly double that. Now what we're seeing is, and I know this is a little hard to see, but as we drop off in these housing starts, that's January of 2025. I mean, that line is continuing down. That doesn't mean that it's actually stopped dropping. So we continue. Now, if you look over to the right-hand side, the right-hand graph, you see it says, why should apartment supply drop below below the pre-COVID averages? So San Diego, the little black box, sorry, it's a little hard to read, but that's San Diego, and that says second half of 2026. So what that's saying is there's an amount of time that it takes to build, to design, to permit, and build out the supply. For large apartment buildings, it's 3 to 5 years. So we've got this pipeline, and it's still delivering and then we can see, the housing starts are off, but there's current construction that's happening. Well, that's going to come to an end. And it looks like it comes to an end right around the second half of 2026, which is when coincidentally our product will be coming into the marketplace. And Angie, you can go to the next slide. And this is just to show San Diego has gone from kind of, it says, 25 to 15, now to 13. So we're moving up the rankings in terms of housing volume, or I should say, apartment volume. And so the market now is beginning to increase. People are seeing what's happening. A lot of apartment investors are scrambling to get in now to grab apartment units while rents are still relatively flat, because the expectation is that they're going to shoot back up again. So you can see that apartment volume last year was up over 50% in San Diego in terms of transactions. So that's what we're shooting for and planning towards in our much shorter cycle time. So what is it? And we talk about backyard apartments and we talk about ADUs. So how do these two things mesh together? So what we do is we purchase single family, duplex, maybe on a higher end of a fourplex. And then what we're allowed to do through the rules that the city of San Diego allows us to do is to build on the space that's in the back of the lot. And so this is actually an example of what we've done on Bancroft Street. Started with a single family home in a single family zone, and we built 6 identical units in the backyard. And we're able to replicate that in multifamily zones and in single family zones, and just really, basically turn what was a residential piece of property now into a commercial piece of property.
Yeah, and so with this stuff, what makes these backyard apartments better than all the other things you can do in the space, right? Well, the big one is the big returns, and we're delivering over 20%, sometimes substantially more than 20%. We just like to under promise and over deliver. So we are saying it's over 20%, but it's likely much more than that. Short timelines. The city wants these things built. The mayor is on the tear to make this thing happen. He hired a whole bunch of a lot more people to make sure the approval happens quickly. We are getting approvals in months, 6 months it takes a few months to get the plans and permits and to buy the property, 6 months to get permitted, and then 12 12 months to build. So we're doing these whole things in 1 to 2 years, the whole thing. And of course, there's a social good here too. We can profit and also be a good thing on society by adding more critical housing. And of course, it's San Diego, so this demand's not going away. I mean, people are going to want to live. Like I said, I came here for the beaches, and I had had to find a good tech job to afford the beaches. Of course, I think most everyone here lives at least in Southern California and understands the demand here. There's this thing I'm calling an arbitrage opportunity, and arbitrage to me is always a beautiful word in business because arbitrage usually means there's quick upside. And that is buying single family homes. We buy single family homes on comps. Whatever the other 5 houses that sold within a mile of them, we use those as comps to buy to get to evaluate that house. But then when we build units on there, we turn a 1-bedroom house or sorry, one unit house into a 6, 10, 12 plex. And now it becomes a commercial property, and that is being sold on an NOI model, which is like an income-based, more of like a business property rather than a like a single-family home. So that's the arbitrage. And of course, like I mentioned earlier, political support. The mayor is really into this. This is his platform that he ran on, helping the homeless, helping the affordability issue. Those are his 2 things that he ran on, and he was just reelected, 2 months ago. So we have that support. And so our investment strategy, what we do, this is the high level of how we do this whole thing. First, of course, we acquire, so we buy the property, we renovate it to a quick, sometimes it's basically a cleanup renovation, and sometimes it is a bring it down to the studs renovation. We get a permit. These are in together in parallel, right? So you get a permit. Then once it's permitted, then we start building, we lease it, and then we sell it right away. And of course, we could hold it forever, but we sell it because our real value add is building, is knowing how to permit and how to build, not necessarily doing long-term rental. It's kind of a different business model. And also for investors, it's much more clear when the exit time is, right? The house is built and leased and sold, and then we're done. Right. And then you're welcome to come back in if you want, but we can return that capital in 12 to 24 months.
Yeah, another thing, one thing that I glossed over is just when we talk about affordable housing, there's a couple of ways to provide affordable housing. One is to have really poor quality, substandard, old buildings that are affordable. And the other way is a lot of the larger projects, they go through they get all kinds of tax incentives, the complex government methodologies where they get funding in order to provide affordable housing. What we're doing, and the way we're able to do this through the city's program, is we actually provide, and it is affordable housing because it's deed restricted. So a certain portion of the units are deed restricted at a certain price, which actually is relatively high. Sometimes it's actually above market rate, but that it is deed restricted, and the other units are then provided as bonus for market rate. So that's how we're able to do so many of these. Anyway, so talk a little bit about our experience. We've got multiple projects that are now actually coming right out of the end of the pipeline, roughly kind of all about the same time. This is a 10 unit. We turned a duplex we added 8 units, turning it into a total of 10 units. In roughly about a 2-year time frame, and this is in the Claremont area, if anybody's familiar with that, in the city of San Diego. And we have multiples of others. I actually started years ago. I thought this would be such a great idea. I was into ADUs before they were cool, so I built one in San Diego it was on an alley, but the rules were so restrictive that they made me sign a deed restricted document that said I wouldn't rent it out and that I would never put a stove in it, which is absolutely ridiculous. So things have changed dramatically since then, and now you can see we're able to put a significant number of these through the pipeline, and now, of course, moving forward, planning on doing a lot more of this.
And we're happy to tour on these properties if anybody wants to see them. I mean, we, Rizwan, we showed the video that him and his family came over to the Delmar Avenue property, and we're, well, actually, some of these were sold and done already, so like maybe we can't access those. Someone else owns them, but the ones that we're building, more than happy to tour anybody if they want to.
Yeah, absolutely.
And of course, we can have all sorts of fun charts and words and stuff like that, but like here's a fun visual of what one of these projects looks like. And so you can see here, broke ground in August of this last year. And this video here, that's November, and then you'll see, boop, that's what it looked like 2 weeks ago. I'll be finishing construction very soon, next few weeks, and then get the certificate of occupancy by the end of March, and then sold this summer. And we're expecting 32% return for all the investors. Potentially, that's even probably a little conservative too, probably even higher than that. But that's what our conservative expectation is on that. So
yeah, and the reason, so our goal is to again be able to do this in much more of a, I won't call it like a factory, but able to do it very repeatable and scalable. And so the goal is to, no matter the size of the project, to be able to get them done in 6 months or less. That's the actual construction of the building. Some things might take a little bit longer. You're dealing with SDG&E and some things a little bit out of our control that might stretch it out a little bit once we're done with the construction. But the actual physical building itself, all of them will be done in 6 months or less.
Yeah, and so one thing, I guess, with my tech background, I actually built a script that pulls in every single property that's listed for sale in the city of San Diego, and it pulls it into a spreadsheet, and then does this deal criteria, filters out the stuff that doesn't meet this criteria, and then does basically a very quick instant underwriting on it. So we're analyzing literally every single property that comes on market in the city limit to San Diego. And what we're looking for, this is kind of an example. There's a few other factors to look into. These are the most important things here. That is, that needs to be a single family type home. So a single family or a duplex. Good location. I mean, North Park, Point Loma, Ocean Beach, Pacific Beach, anything that's Class A, Class B, real, not, good or great neighborhoods. It doesn't have to be beachfront, but it has to be a good neighborhood for the rent to be there for this business model to make a lot of sense. We're looking at properties that are basically $500,000 to $2 million in the city of San Diego, because the rules that we follow are the city limits, right? So if Del Mar, National City, Point, Poway, Ocean Beach, or Oceanside, those do not work. It's just the city limits of San Diego. Mm-hmm. Now we're focusing on RM zoning too, which is multifamily, which is really what this makes a lot of sense to do multifamily. You can do single family, but again, it makes more sense for us to do it here in the RM zone for a couple of reasons. Big, relatively big flat lots. The rents need to be over $2,000 a month for a single bedroom apartment. We need to build at least 4 units, and we need to have a buildable area about at least 40 by 40 feet. And so these are all like at least, of course, it needs to be bigger than all of these. And so, like I mentioned, we have an automated property search process where it scrapes all of Redfin and Zillow and pulls that information in, and it grabs other information from across the other platforms like the zoning and stuff like that. So that's all done automated to make sure that kind of 80% of that legwork is done through the automation process. And of course, we then have a team member who goes and double checks it. And then once that is done, once the initial review is done, then we build a full pro forma. We go through and make sure we analyze, look at comps, look at really close, really comparable properties. And then once all that looks good, then we start hiring consultants, land use lawyers, architects who specialize in this process. And we're very, very familiar with this process, but we need to have professional, experienced people on top of what we're looking at to double check what we're doing. And we have a whole team of land use lawyer and other people specialize in this thing. And then we make an offer. get the property under escrow.
You actually have a family member who is who's a commercial appraiser.
Yes, and she's investing in this deal
And
too.
she's investing in this one.
Yeah.
So that's a pretty good note of confidence. Yeah.
Yeah. So what is the property that we're looking at today? That's all the why and the how, and here is the what of what we're looking at. So we're looking at this street on Tennyson, which is so 3754. You guys can look up on Redfin or Zillow or Google Street View if you want. But you can see here, I get my little marker out. There we go. It's in the heart of Point Loma. It's in a really nice area of Point Loma. So we're, downtown's right here. And I think most people are familiar with San Diego, but just to kind of give you guys kind of a quick lay of the land, the, Ocean Beach right here, really nice beach and surf area. Of course, Mission Beach and Pacific Beach here. La Jolla is right here. This is a premium spot of San Diego. Downtown's right here. Airport. This is, very nice part of the city. The street itself is also very nice too. It's a nice spot. Purchasing for just over 1.4 million. Currently, there is a 2-bedroom unit and a 1-bedroom unit on there. The average 1-bedroom rents in this neighborhood are $2,500 a month, and then the 3 bedrooms are $5,500 a month. Our lot size is 5,600, and our zoning is multifamily. So this all meets those criteria that I talked about before. And so I looked up. I had to look up Tennyson. It's kind of a funny name. It's named after an author, Lord Tennyson, and he had a quote. He's most famous for "'Tis better to have loved and lost than to have never loved at all." That's his most famous quote, but not as relevant as this one for us, which is "Come, my friends, 'tis not too late to seek a newer world." Which I thought was a pretty spot on quote for what we'd like to do here, which is to take this single family home and turn it into a multi-unit apartment complex. And here I just have a quick render that I got done in a few days, just to kind of show the concept here, right? It would be row houses, townhouse style here in the back. And we actually are going 3 stories on here. So we are able to go 3 stories. Could even go 3 stories on this primary home here, but we're likely going to keep that 1 story and not touch it. But we'll get rid of this little house in the back and go 3 stories back here. And
Yeah, another thing about the location is as Andrew said, it's great. These kind of units are perfect for students. There's a Point Loma Nazarene is at the end of Point Loma. There's also the Naval Sub Base, which is also at the end of Point Loma. So lots of military. There's also sub base on the other side of Point Loma on the base side. Excuse me, not a sub base, but a naval base. And Marine Corps Recruit Depot is there as well. So a lot of good steady employment from the military side as well as, like I said, like university as well.
And all the neighborhoods in this area already have 2-story, 3-story builds and ADU style properties. So it's not out of place. It's very much, along the lines of the other things that are going on in that property, in that neighborhood. And so here are some of our numbers. Again, purchasing for 1.4 million. We're going to build 5 3-bedrooms and 5 1-bedrooms. Renovations and permitting will cost about $180,000. The cost to build is $2.5 million. Timeline is 1.5 to 2 years. Estimated rent at the end is $35,000 a month, and we think the value after we build everything will be $6.8 million. That is not including any appreciation. So generally, San Diego appreciates about 6% a year. So we expect that to be maybe 10% higher than that. But we're just assuming flat appreciation, just so we're conservative. We have what's called an equity waterfall. So we have a 8% preferred return. That means that we make sure that of all the first thing we do is pay off the bank when we sell a property, pay off the bank. Then we return capital to the investors. So everyone's getting their money that they put in back. And then the first profits go to make sure the investors get at least an 8% a year return. So if it takes 2 years, you get 16%. just to make sure that all profits go to that first. Then after that, we do after that, the next, we call it tranche, we get the investors up to at least an 18% return a year. And then 70% of all the profits, the next profits, go to the investors for that. So I have a whole spreadsheet that talks about the equity waterfall, but for the sake of speed and clarity, I'll just leave it there. But at the end, we expect our profit to be 2 million, and our annualized returns, or IRR is what they call it in the real estate industry, of 25 to 35%. Yeah. So why don't you take the risk part, Marcelo?
Yep. Yeah. So as Andrew said at the beginning, and this is one thing that we want to really emphasize, is we focus more on the downside than the upside. Those returns look great. I actually am constantly telling Andrew to reduce them because I just feel like although that's great, it's also super important to make sure that your money is safe. So, what are the different risks, right? So market fluctuation, both in terms of just value and interest rates. People have been talking about, for whatever it's been, 6 months or something, the expectation that interest rates would go down. Well, maybe now, maybe not so much. So what we do is we don't take in any kind of positive potential market fluctuations into account to boost our return. We make sure that we will be able to, on the back end, be able to basically be at roughly a 50% equity to debt position, so that if anything happens, we would be able to refinance and have the income cover our expenses on the project. So that's really how we manage to maintain our risk at what we consider an acceptable level. Project timelines are another thing that can expand, and again, time is more important than money. And when you're in a high interest rate environment like we are right now, we want to make sure that we don't extend our time frame. So that is something that's realistic, but again, we try and make these very repeatable so that we understand what it is that we're what we're looking at. We understand that, hey, we're kind of doing something that we've already done, so we're going to do it again and then again and again. We're not reinventing the wheel. So we really try and keep a lid on that. Budget overruns. I'm a general contractor, so I keep very close eye on the costs and ways that we can find to reduce our cost as much as possible. Because again, the more the costs go up, that's in the denominator, reduces our return. So we want to do everything we can there as well. And regulatory challenges, there's always the possibility that the rules on these kinds of things can change. As Andrew said, we maintain close contact with the city as well as with land use experts, so that we know what's coming down the pike. One good thing is that we're able to relatively quickly, certainly when you compare it to a large apartment complex, to do the design and development. We work to get all that done in under 90 days, so that as we're going through that process, we can get it into the system, and then once we're in, we're in the permitting process.
Yeah, the beauty is that the ADUs are by right. There's no community review or the council doesn't have to approve. It's as long as you qualify with these criteria, you get it.
Yeah, there's literally, you can go on the website and it's very clear. They detail, it's 3 or 4 pages about everything that are needed to meet that criteria. Anybody can go look it up. And again, market fluctuation, I kind of cover these, but in terms of our conservative projections, we do get appraisals from third parties. So Andrew, super smart guy, he has all kinds of underwriting. We pull information from various third-party sources, but we then also go out to other people that we pay and say, hey, we're not going to tell you anything. Please, you come back and give us your assumptions and your numbers. And like I said, we want to build to like a 50%, more or less 50% equity position, so that we don't have to ever come back to our investors and say, hey, we need some more capital in order to, ride us out through whatever may be happening at that time.
This one, to me, we talked about before, but the no appreciation assumption. And again, the goal is to make these things so short that appreciation is not meaningful, right? Yeah. But again, we should expect a 6%, what we see annually in Southern California has done for the last 60 years. But these are, that's another kind of conservative assumption there. What's next here? Yeah. Oh, kind of covered a lot of the stuff already, but
we kind of a little bit
quickly.
Yeah, I'll just say quickly. The construction, it's what's called type VA. So wood frame construction, very, very quick. Our teams, we're using the same teams to do these. So it's a little bit like when you go talk to somebody, it's kind of like, hey, just like we did 6 weeks ago, this is what we're doing again. And we also do use Monday.com, which isn't specifically a construction management software, but we use that to keep ourselves on track. And in fact, we'll provide Gantt charts and such that the investors can take a look at as we go through our construction. And I think I've talked enough about the regulatory challenges. If there's any risk there, we can. I
guess one thing we could add is that there was a news article. I'm sure not everyone follows it as close as we do. We do stay on top of this stuff pretty closely. There was a news article that came out a few weeks ago saying that the cities are reconsidering the bonus ADU rules. They've reversed that reconsidering. So they're unconsidering the reconsidering now. But of course these rules do change. But the change does take months or years to go into effect, and we're taking weeks or small months to kind of get our stuff in. And they give us a lot of heads up, a lot of notice, a lot of city council minutes are being published and stuff. So we're staying on top of all the stuff. So as of right now, it's smooth sailing, clear skies ahead. And then I mentioned before, but our number one way of exiting, I would say the person with the most options wins. So we need to make sure we have plenty of options just in case, hope for the best, plan for the worst, but we need to have multiple options here. Number one here is to lease it and sell it immediately. That just makes the most sense for investors to come in, just because the short timeline has a high return. We specialize in permitting and building, not necessarily in long-term rentals. And of course we do have a professional company that does the leasing and management and stuff. But that's the number one exit strategy. You can also hold it. We would just refinance it and go with cash flow. Again, this thing should have great cash flow, so it'd be really easy to refinance and hold it. And then another one that's kind of interesting is you can sell properties, what's called shovel ready, meaning if we couldn't for some reason actually do the actual construction, we can sell the property with permits in hand, and that's very valuable to people because that means that somebody else would come in and build it up right away. And so there's just different options just in case. It's not all contingent on a single plan. We have plan A, B, and C, and probably another D and E if we need to too. And our last slide here, we'll open up to Q&A, is what makes us a little bit different. Well, we are experts in ADUs. This is all we do, just ADUs. Marcel is fantastic at build execution. He's done a bunch of these things. And he's very quick and efficient, doing basically rinse and repeat this thing over and over again. Tech driven with that, the scraping and the automated underwriting that we talked about. And then another big one too that I didn't know this was special because I don't know. I talked to a bunch of other people and they're like, oh, I'm surprised you do that. That makes you very different, which is a large co-investment. Myself and Marcelo put a lot of our own capital into this, and our friends and our family are in these things. So it's not just strangers in these things. I'm putting in $100,000 in every single deal at least. And of course our, day job is connected to this too. And my dad's in it. Sister-in-law is in it. Some of my best friends are in these deals. So this is a large co-investment thing too. So we'll talk here about how to get started. If you're interested, that is to go to this website, which I'll put in the chat, and then we can open it up to Q&A. Yeah, so this Avestor platform is a platform that we have set up, and then if you're interested, just soft commit. Soft commit has there's no legal implication. It's just to kind of gauge people's interest in this project. Mm-hmm.
Any questions?
I have a few. If you don't
Okay,
mind.
yeah, I know. Go ahead.
Sorry, I hope you don't mind the dog. Can you guys hear the dog?
It's okay.
No.
A little bit, but it's okay.
Um, yeah, she likes to hold it right when I unmute. Sorry about that. So one of Marcella's posts on LinkedIn was described some of the lessons you guys have been learning, because I mean, you guys have been at a super quick pace, so I'm impressed that that there are lessons to be learned. But I'm curious, what are some of the lessons that biggest lessons that you've learned that you've been able to work around?
I'm sorry, you cut out. So I'm going to summarize. There was a portion where you cut out. Lessons learned along the way that we've done? Yeah.
Yeah, what
Okay.
are some of your biggest, and how have you adapted?
Yes. So, Andrew, I'll take this, and then if you want to add something, I would say, so some of the biggest ones involve parties that over whom we don't have control. SDG&E is one which I could talk about for probably an hour or 2 hours or 3 hours. They are a regulated monopoly, and people like to talk about government, and they like to complain about the government. Whatever. The city actually is not they're not that bad to deal with. SDG&E is really really awful, and so we actually now have to pay a third party to interact with them because they just simply won't answer you now. You actually have to pay a third party to do that. So that's one thing we've done. Found a good third party to interact with SDG&E, and we engage with them even before we begin the actual design process. We actually begin the process with San Diego Gas and Electric. That's a big one. The other one involves fire and fire sprinklers and the difference between commercial and residential. So one of the things that we do is actually our projects, they're actually technically, they are, in terms of the city, they are multiple projects. So each one of the units is a duplex. So we'll have 1, 2, 3, 4, 5 projects with the city. And that's simply because that's considered residential construction. So in that way, there's some things that we don't have to do, like in terms of, one of the big ones is fire sprinklers, and commercial just puts you in a whole different realm, which costs so much more. You, instead of being able to use like a PVC type piping in your plumbing, you have to use like actual cast iron, for example. It costs much more. A different gauge of wire for your electrical. So there's a bunch of different things. So we stay within residential, and we also, again, we work very quickly with SDG&E. I think another thing, something that I had learned, is there are certain parts of San Diego that have, and they're more kind of around the airport, and I have not with the fund, but with a couple of other projects that I did, where they've changed the earthquake map.
Oh.
And you have to do a lot of geologic testing. So that's one of the first things that I look for now, is to make sure what zone we're in, because they can then make you go back and do a lot of geologic testing, which takes time and money. And we've never run into a problem with it, but theoretically you could run into a situation where it could affect either the design of the foundation, or even if you can or cannot even build a building on a particular lot. So those are some big ones right now.
The thing I'll add is having independent people analyze the deals independent of me. So like not telling them my assumptions and asking if they think if I did it correctly. I just tell them, like, here's the address. You tell me what you think. What would you're a professional, you're a special, whatever the thing we need help with. You tell me what you think you would do with this property, and then I can see their assumptions and cross check them with our assumptions, just to get that independent thing. It seems if we all, the land use lawyer and the architect and the other appraisal guy and the other developer guy, if we're all coming to the same conclusions, I'm like, okay, that seems like we're all on the right track.
You'll get caught by someone.
Yeah, and everyone has slightly different assumptions, right? They assume 3 things like this, and they kind of add up different, and it, like, oh boy, we need to double check this. We actually had a property about 6 weeks ago that we were in escrow. put $30,000 down on it. We were out of remove contingencies on it. And I had some people relook at the numbers and they just said, no, some of these assumptions are not right. And the numbers didn't look very good. And I'm like, we can't do this project. I'd much rather lose the $30,000 of earnest money than to do this project. And we might make $250,000 on a $3 million project. And that's just not enough. That would barely maybe pay the prefs, but not pay any real returns. And we just killed it. Just lost the 30K and moved on.
So my other question is, Tennyson in particular looks great for Airbnb. And it sounds like you are doing an Airbnb. Are you optimizing the ADU selection for Airbnb turnaround?
So
that-
the front house, which is existing, we can do Airbnb.
Yeah.
There are all kinds of restrictions on Airbnb and ADUs. So it's the main house can be. The other units, I think the ones that you get by right, I'd have to double check, could also be, but definitely the affordable ones you cannot.
Oh,
Airbnb on those. So our main thought has mainly been with the existing house for Airbnb.
okay.
And that's also not in the pro forma. There's upside to that. We're not including that in the pro forma at all.
Yeah, we have a Airbnb professional management company that's helping us design and pick out furniture and stuff like that. The big one is on Delmar Avenue, which Rizwan is invested in that one. And he's projecting we're going to rent that property we'll gross $150,000 a year on that one because that's a big ocean view and everything, right? Tennyson, he also did an evaluation on it, and he was about half as much as that, just because the property's a lot smaller. It doesn't have the ocean view. But the nice thing is that that's all just, like Marcelo said, that's all just cherry sauce on top.
Okay. Any accommodation you have to make for parking? I hear that's a complaint some officials are making, like in North Park and those areas. Does Tennyson
North
have
Park
parking?
North Park is tough because they're putting up. There's another opportunity called Greater Communities where you can build like apartment buildings and zero parking requirements. And so that's tough. I call those parking bombs. If you put 50, 60, 70, 80 unit building and it has no parking in it, that's going to be tough. This is in more of a residential area, so there is off-street parking. There's a couple of spots on the property, but this is not like North Park where, they're building these big buildings with zero parking. So it will have to be off-street, and we actually adjust the rents for that. Our rents are kind of conservative because of that. So it's an issue, but the city said, well, what are options? Either we can have a bit more of a parking problem or a lot more of a housing problem.
Go ahead, Rizwan.
No, I'm sorry, Andrew. I just want to double click on that. I think that was my only question in the presentation. You guys mentioned that, where this property is, there's few other ADUs. We are building 10 units. Let's presume there's 2 cars in each unit. That's just 20 cars coming in just for this unit. And if there are a couple others, just from the the location perspective, what would it do to the future value of the property? Would people be interested? Like, I'm just thinking about myself. If I put myself in the shoe where I need to rent an ADU, well, I want to make sure there's parking. I'm not going to run into this challenge all the time. So I don't know if you guys have how do you guys think about this? Where street parking is okay, but if there are multiple ADUs in close proximity, what would it do to the parking?
Well, so the current yard's already filled up. So it's basically
I should say, when I was at Caesarina both times, I was frustrated with parking in that area.
Yeah, so the yard's already filled up. So there's probably not a lot of opportunities to build more ADUs out there in terms of like adding more units. But we do come in with no or limited parking, additional parking, for the initial underwriting, and then we try to find places to add parking. So in Del Mar, I don't know if I mentioned this in the emails, whatever, but we were able to squeeze, move some things and shift a few things, and we were able to squeeze 8 parking spaces in the back, which is great. That's going to help a lot.
It's awesome.
But this one, as of right now,
and we'll also be charging for those. So that comes at a premium, right? I mean, people are going to pay. So, again, I think the important thing is these are affordable. So our underwriting is based on affordable housing, which is below market rent. So there is off-street parking. There is, in fact, across the way, there's residential, and so there's plenty of parking across the street. So I think there's a couple of things with this area. One is it's already built out, so there's not additional building that really can happen there. Everything is already built, and there already is some parking right there on the street. And again, across the street, there's residential where there's quite a bit of parking.
Thank you.
It is a legit concern, though, and it's something we're
it's
trying
something
to
we always it's something we always take into account. And there, for example, and I think certain parts of OB are a good example. Certain parts of North Park are a really good example where I wouldn't be comfortable maybe building 10 or 12 units necessarily in some parts of North Park, but you just can't park anywhere. That's not the case here.
Is there public access? I don't know that area very well, but bus system.
Oh yeah, there's a bus stop right there, literally on the corner. Absolutely.
Okay. Is there a chance for a tour on any of your?
Yeah, absolutely.
On any of your properties? I'd be curious to check some of them out.
Yeah, absolutely, for sure.
Yeah.
Right.
Yeah, maybe I'm trying to think, maybe Bancroft. The appliances are already installed. Last big thing is railings. I wouldn't want to have anybody go through without railings, but I think our railings are up now. I have to double check. I know that's scheduled to happen this week. Yeah.
Okay, that'd be great. I think we're close to time, but you guys have been doing amazing work. I mean, very impressive. So
thank you.
Thanks you for this.
Rob or David, do you guys have any questions?
Yeah, we are coming up on a hard stop.
Yeah, I have a lot of questions, but I think I'll probably Ken mentioned you guys went for a walk and he and I have hiked a lot together. So I'll probably meet you in person, Marcel, and I'll ask you a bunch of questions about the construction side of things. I maybe I'll throw up one question. You mentioned the affordable housing, the delta between affordable housing on the income side versus going rents, let's say for a non-qualified affordable housing. What's that delta, roughly speaking?
It depends on the submarket. So, if you are in, let's say, Logan Heights, I mean, market rents are going to be well below what the affordable is. If you're in Ocean Beach, we kind of match it. Right now, it's almost $2,700 a month.
Yeah, and so it's based off of area income, median area income, and there's this whole equation that they use to calculate it. But the short of it is, a one-bedroom apartment is $2,700 a month, and that increases when incomes in San Diego go up. So if incomes increase by 5%, or with inflation 3 or 5 whatever percent, that price would also climb up with it. And so right now, again, $2,700 a month. Likely when this project is done, it's maybe 28, 29, maybe 20, let's say 28 to be a little conservative, right? 2,800. We're projecting rents at 2,250, 2,300, right? And I'm happy to share a pro forma too if you want to look at all the diving deep on the spreadsheet numbers. But that number, the delta, at least for this neighborhood, the delta is $500, $400. So it's pretty big. It's very unlikely that's actually going to cap the rent income.
Okay. I like your conservative approach. I was just thinking when you're describing that 2,200, I was thinking, well, good, they've guarded against sensitivity analysis on the model is going to be less impactful on the downside. You're probably going to gain more on the upside if the rents are better. So
that's the whole thing of affordable housing is that, and that's why I like to emphasize is the downside, right? I mean, when you're already coming in with the assumption that, hey, we're going to be a notch below what market is, then should something happen and people need to move from an A to a B, that's where we are. So
yeah, you protect your downside, the upside will take care of itself.
exactly.
Rob, I heard you drop that keyword sensitivity model. I have a sensitivity model and I have a whole blog written about it, and I'm finding the link for you. I'll get it to you here. Right?
I'm a tech geek too, and a
right.
data and a good financial background. And if you guys haven't gotten into AI yet, you mentioned you wrote some scripts. You can throw those away because I've had my eyes open the last 4 or 5 months to the depths of AI, and it's unbelievable. And I've been in tech my entire adult life.
Yeah. I use Claude AI all the time for coding, and they just released a new thing for specifically where you have like a side-by-side coding platform. But anyways, that's probably outside the scope of this call.
Yeah, I was going to say.
I'm super into it.
I know I have to go, but
we've been writing code with Windsurf, so I'm using the coding platforms already, and it's unbelievable, really.
It's mind-blowing.
Yeah, get Grok 3, by the way. I've been playing with Grok this week, so the new Grok.
Yeah. I actually want to, sorry, I should geek out on it, but I won an AI hackathon last summer or something else. So, yeah, I'm super into it.
I just got one quick question.
Go ahead.
Yeah, sounds like you guys have been cranking these things out for a while, and that's outstanding. And it seems like you've got a great working relationship with your local mayor and the regulatory folks. I'm a Bay Area guy, so we're in a different world up here where they love red tape and things are a lot longer and a lot more bureaucratic up here. So crank them out as you can, as long as that mayor is stamping approved on all your proposals. One quick question though, is any of your analysts, anybody looking at with the new possible tariffs coming, increased labor and materials costs, lumber packages, stuff like that going up by significant amounts?
Yeah.
Have you guys baked that into your models already, or are we waiting to see?
No, we're increasing assumptions about increased cost
already. Okay. And then I guess kind of a part 2 on that. What about you guys have your own in-house labor, your own build teams, or are you guys subcontracting everything out, and are those costs going up?
It's a combination.
Okay.
Costs are always going up.
Yeah.
And they're going to go up. We have I don't know how to put this. The policies that are currently in place are pro-inflationary. So
yeah.
And I'm going to assume, and we are assuming that, and again, what I showed with the rents is that the rents will also correspondingly increase as well. So our costs are going to increase. Labor and materials, and also rents will increase. And unless the bottom falls out of the world, we would expect to also see some continued pressure, for people to be, getting increases in salary and everything. So it's all, which is why you like real estate, right? I mean, real estate is one of the most ultimate inflation hedges.
Yeah.
So although interest rates are staying high, being in real estate is the place to be for that situation.
The bottom falling out would make me sad, but we can actually survive 16% decline in the market. So, and I just put in the chat there, there's Rob, there's the sensitivity model. It's for Bancroft, but it's this very similar model, very similar.
And actually, during the great financial crisis, or global financial crisis, whatever you want to call it, rents in San Diego dropped about 2 to 3%. They didn't drop by 16%. So, people who were buying or who had owned a house who had to now not own a house were renting. They became renters. So,
Sorry, when I say survive, I mean that would be we finish a project and everyone gets return of capital, but not return on capital, meaning you'd receive all the stuff. Of course, the lose all the capital would have to see like a 40% decline in market, right? So 16%, we would just break even. After 18 months, it'd be sad we didn't have any return, but those are the model. Those are the kinds of things that we like to model and make sure we're able to handle those kinds of things. Yeah.
oh, sorry.
Yeah, we all just have to keep our eyes on the global liquidity. That's and the strength of the dollar. That's what's going to decide everything. And I'm not overly concerned right at this moment. I don't think I don't think Trump administration and the Fed are going to put a pin in the economy. I think they're going to relax their view on inflation, and it's closer to 3% than it is 2%. They're going to get used to the normal. So
when I bought my first house in San Diego, I think my mortgage was around 8%. So
I'm a big believer in consistent investing, right? You don't really want to time the market, whether you think that this person or that person or this force is going to hurt it or whatever. It's like as long as you're consistent and diversified and consistent is really the key.
Yeah.
Can I ask one more question? I just have one last. Just wondering, Marcelo, have you given any thought to this kind of idea? I've noodled on it for years, and I toured a factory when they first started building houses inside of a factory. And, Elon Musk has been talking about the tiny homes and so on. Have you guys looked at, if you have ingress, egress into the property, have you guys thought about dropping, pre-built homes on there?
Yeah, it's not nearly as good as it sounds, unfortunately. Yeah, we've priced it out. You save a little bit on time, but it's more expensive. Actually, per square foot, it actually costs more to bring in manufactured homes.
Manufactured homes.
There's a whole slew of reasons for that, but they're actually more expensive.